SoFi's management team spooked stock market investors, and SoFi stock is down almost 12% on the day following the company's quarterly earnings announcement. I should say, on the day of the company's quarterly earnings announcement. That's where the management team made a comment that sent the stock price down as they scared investors. I'll talk about what that comment was and why it sent the stock price down. I'll also review the company's latest quarterly results, and I'll update my recommendation of SoFi stock. Of course, this big stock price decrease is a disappointment to me. I've had SoFi stock rated as a buy for over a year now, and so this decrease is disappointing to be sure. But let's take a look at the results and let's see if this is a buying opportunity.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so as I highlighted, I've had SoFi stock rated as a buy for over a year now, and I last updated that recommendation on January 15th. But if you remember, when I did that video, I warned investors not to buy SoFi stock or not to buy all of your allocation to SoFi stock before the company announces earnings. And this is one of the reasons why I do that, is because following an earnings release, oftentimes the stock price is volatile and you can see price swings of large magnitude like we saw with SoFi down 11%. And so if you followed that recommendation where you did not buy before earnings, now you have an opportunity, if you're still interested after we review, to get SoFi stock at 10% lower, 11% lower. But let's review the results and let's see if it's still a buy. I'll update this recommendation towards the end of the video. So in the fourth quarter, their financial services and tech platform segments made up a record 49% of SoFi's adjusted net revenue. That was up from 40% in the same quarter last year. SoFi's management team has taken a deliberate shift towards capital light, higher return on equity, cash, fee-based revenue streams. In other words, SoFi wants to move the business away from lending and towards everything else. Because everything else that they talk about here, the tech and financial services, those come with higher returns on investor capital and lower risk. When you're lending money, the risk of default is high. And so if your borrowers default, that's a loss to your company. And so you want to shift away from that risk, especially the type of loans that SoFi makes. The vast majority of the loans that SoFi originates are personal loans, which are the riskiest types of loans you can make. Now, I was happy to see its student loan segment and its home loan segment grew much faster this quarter than the rest of the business. But the lending segment revenue, remember, to start 2024, management was saying that they expected lending revenue in 2024 to be down 5 to 8%. That was their forecast coming into 2024. At the end of the year, their lending segment revenue was actually up by 8% instead of being down by 8%. Big difference between what they forecasted to start the year and what actually turned out to be the results for the year. The big difference is that coming into the year, management was fearful of a recession in the US economy. They were concerned of rising unemployment, rising interest rates, causing a slowdown in economic activity, which would cause people to lose their jobs and cause them to miss their loan payments. And so SoFi started the year on a very conservative approach, cautious that that recession could hurt its business significantly. But as 2024 went along, the management team started to look at the data. Economic growth was much better than forecast. Unemployment was much lower than forecast. The economic performance in the US was much better than it was forecasting. And so it boosted its lending throughout 2024 and increased the forecast and actually ended up much better than it was expecting in 2024. So then if that was the case and the lending revenue did much better, why is the stock price down by so much following this announcement? All right, so here is the statement not even a full sentence, a back half of a sentence that sent the stock price down. In my opinion, this is the thing that sent the stock price down. In giving the guidance for 2025, just like I talked about how management gave their guidance for 2024, now they gave their guidance for 2025. And in that guidance, the first long sentence and the back half of that sentence, management said that management wants to better tilt the incremental revenue growth toward investment. And first, they start off that sentence saying that in 2024, their profits grew more than they expected. And so for 2025, what they want to do is instead of letting all of that revenue growth lead to higher profits, they want to take that revenue growth and reinvest more of it into the business. So rather than allowing that revenue to lead to higher profits, they're going to take that revenue and invest it back into the business. Most likely, this is going to lead to higher spending on customer acquisition. That's my speculation, is that most likely this higher investment is going to lead to more customer acquisition spending, more spending on advertising, on marketing to attract more members to the business. And so that's where investors were like, we're not happy about that. Your business was doing so well, the growth was so nice, but now you want to push the pedal to the metal here and try and accelerate growth when, as shareholders, as investors, we would have preferred you let that revenue growth just lead to better profitability and don't accelerate growth. Grow slower, but more profitably. That's what investors were disappointed about. And I'm on the fence about that. SoFi doesn't have enough history where I can feel confident in giving this management team the benefit of the doubt, right? If this was Netflix and Netflix said we want to invest more in content, I would be cheering the news. In fact, that is what Netflix said, and I made videos cheering the news, but it's because the Netflix management team has demonstrated to me for over a decade that they're really good at spending money at improving the business. I've seen that over a decade. And so I have enough history, I have enough data where I can confidently feel that way. With SoFi, it hasn't been around that long. It hasn't been doing this long enough for me to say, you know what, if management thinks it's lucrative to spend money on growth right now, I think we should celebrate because management is good at that. I can't say that. I can't come to that conclusion because I don't have enough data. I don't have enough history. I don't have enough confidence just yet. Even though so far they've done a good job, I just don't think there's enough data to come to that conclusion, especially because they haven't gone through a proper recession. If I had observed SoFi for, more than 5, 6, 7 years, and included in those 7 years was an economic recession, and the performance of their loan portfolio during that recession was solid, then I could be more confident in saying when management spends more money, then it's a good thing for investors. I can't say that one way or the other because of the lack of data. Okay, so now after this earnings report and the stock price decrease, SoFi is trading at a forward price to earnings of 39. And remember, when I did my discounted cash flow valuation on SoFi stock, I came to the conclusion that the intrinsic value per share is around $19.84. The current market price is $15.81. And whether I look at the forward PE or I look at the DCF, SoFi stock still looks undervalued to me. So the reason for the stock price decline is not a certain bad news event for me. It's more of an uncertain. It could be bad. With more spending, profits could come down. The spending could be wasteful, but it can also be good. And I'm not convinced on either side. If I was to lean towards any direction, I would lean towards the increased investment is good because so far, SoFi has demonstrated that it invests in profitable growth, that its business model is so much better than the competition, right? Legacy banks with all their brick and mortar establishments are so wasteful because customers are not wanting that, and those banks are spending so much money on brick and mortar, while SoFi gets to invest in tech improvements that customers prefer much more than having a physical branch that's understaffed with people that are undertrained. And so, for that reason, I'm leaning towards giving SoFi the benefit of the doubt even before I have enough data to make that conclusion. So, to answer the question, is this a buying opportunity? I think so. And I'm reiterating my buy recommendation for SoFi stock on January 27th, 2025. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.